Welcome to the IRS Debt and Audit Podcast with Brian Logren.
Hey everyone, welcome back to an all-new episode of the IRS Debt and Audit Podcast with Brian Logren. I'm your host, Mike Leon. You know, Brian here is a seasoned tax attorney based out in Tampa, Florida, and the founder of Tampa Tax Relief. And for more than 25 years, he's been helping individuals and business owners all across the country resolve serious IRS problems, everything from audits to tax debt to even cases in the U.S. tax court. Today's episode, Brian's going to explain the IRS financial disclosure process, including the forms that are often referred to as the 433 series. I have no idea what those are, folks. I thought it was a BMW car. It's not. And how the IRS uses that information when reviewing someone's ability to resolve tax debt. Brian's going to explain it all in just a second. Brian, it's good to see you. All right, I said those numbers, 433, okay? I don't know what it is, but I've heard, you correct me if I'm wrong, that in many IRS collection cases, the agency asks the taxpayers to complete these financial disclosure forms. So what role do these disclosure forms play in resolving the tax debt?
Good to see you, Mike. They're actually the blueprint that the IRS is going to use when the balance is determined. And there's not a dispute per se. You're not in litigation over the amounts that they're saying is owed, either on the IRS's part or the taxpayer's part. But when you've determined that this is the actual balance, it's for people that are in a situation where they obviously just can't write a check. And I tell people all the time, they say, gosh, I need to talk to you. I mean, we don't have the money to pay this. And I'll kind of jokingly say, well, I'm sure if you did, you wouldn't call me. You'd just pay it off and move on. They're like, yeah, you're right. I said, well, here's a situation when you get above a certain dollar amount, and this amount has fluctuated kind of over the years. I've seen conflicting dollar amounts, various places about it. But basically, when you have a balance, and for the longest time it was over 50,000. Now, in some cases, just depending, it's if it's over 250,000. But you get into a situation where you say to the IRS, look, in order to pay this balance in full before the CSED dates run, we talked about that in another episode, what those CSED dates are, which the dates which the IRS can no longer collect on a particular tax year. In order to set up some type of an arrangement, a payment plan, or what's formally referred to as an installment agreement, to set that up in an amount that oftentimes is less than what will pay it within that CSED time frame, the IRS says, well, we need to get your financial information. And like so many things with the IRS, it's on a pre-printed form and you plug it in. And of course, most of these forms you can fill out right on the IRS website and then print it that way. And the 433 is for individuals and for businesses. And it's basically a list of income and assets. And the IRS will extract from that what they believe is a sufficient payment. Again, oftentimes if it's under or within the CSED time frame, that they're not going to get paid. And basically you have two versions of it, the 433A for individuals and a 433B for business. And let me just add one other part. There is a 433A OIC, which is for offer and compromise. Again, we've talked about that. That form is much more extensive, as you might imagine, because an offer and compromise is just a much bigger process. There's so much more detail that the IRS is looking for. But again, 433A for individual, 433B for business.
Brian, before we get into what the IRS is looking for from these forms information-wise, can I just ask you, because you said the word situation, and then you gave like dollar figures or maybe amounts, but is there like a particular situation that the IRS is typically requiring someone to provide such detailed financial information? Like, is there a through line of typical, this is a textbook situation, this person owes this and they've done this? Like, is there something like that?
Well, before COVID and maybe back to 10 years ago, there was kind of anything above 50,000 had to have a financial, which was the 433. And then COVID hit, some things changed and so forth. And so there's been more leeway. And I will say I've had cases where I've resolved matters that might fall outside what they show as some of the parameters on the IRS website about the hard dollar amounts. The biggest thing is this. Since COVID and since the IRS staffing has gone down quite a bit, there are situations that in the past somebody would have to have a financial statement. But the IRS is basically saying, look, if we're going to get full paid within that CSED time frame, we're willing to, in some cases, forego the financial statement. It's oftentimes really two things. One, if the balances are not going to get paid within the CSAID time frame, and meaning the IRS is going to lose money, if you will, at the end. Or you have an individual that the IRS has determined has a very high income, not necessarily net worth, but high income. And the IRS is saying, well, yeah, it'll full pay it within the CSAID. We think you have the ability to full pay it a whole lot faster than that based upon your income.
Okay. Now let's get to the forms part of this. So a lot of the times this disclosure is asking for income, obviously, expenses, assets. From the IRS perspective, you know them better than maybe most. What are they trying to understand when they're reviewing all of this information?
First, they're looking at income. And I mean, it's the income tax. And I tell people that it's not to be flippant or sarcastic. It's called the income tax. It's all based upon income. So when you have a tax debt, the first thing the IRS is looking for is what is your income? Because I've situations where I've had people owe seven figures, over $1 million, and their income is under $30,000 a year now. I've had situations where people owe $30,000 and now they're making $1 million a year. So the IRS wants to know what that person's income is, because from that point, kind of working backwards, that's where the IRS comes in. Because keep in mind, when you have a tax debt, even though the CSAID might run 6, 7, 8, or 10 years, I mean, the IRS isn't going to sit and say, okay, well, you owe us blank amount. We've got 10 years to collect, so let's divide the balance by 120 and factor in interest. They don't do that. They're not a lender. It's not like buying a boat or even taking on a mortgage where you're trying to get it paid within 10 years or something like that. They want to get paid as quickly as possible. So they're not always automatically willing to just take the balance and divide by the CSAID and say, hey, we're good with that. So it starts with income. That's the number one thing they're looking at.
Yeah. Brian, let's go back to the two scenarios you gave, right? I make 30 grand and I owe $1 million, which is crazy. Or I make $1 million, I owe 30 grand. In those situations, obviously without giving the specifics, but like as the financial picture was presented to the IRS, like how did the case evolve? How did it move forward? How was it resolved?
Well, those are like real far extremes, but really what happens is oftentimes, and again, most of our clients are small business owners and or self-employed, meaning they don't have taxes taken out, which is oftentimes a large reason why they fall behind. But have a situation where somebody's been making good money, and certainly there's turns in the economy, or oftentimes you have somebody that's got kind of a physical job. They work outside, maybe it's in the construction trades or related to that, and they're making quite a bit of money, and they run up a pretty high tax debt. And all of a sudden something's happened. Either they've gotten a lot older or they've had some type of injury or something like that, and they can no longer earn in the way they did before. So their income has gone way down. In other cases, somebody is, really managed to turn the corner in a business or in a profession or some other fashion, and all of a sudden their income has gone way up based upon a low debt. But things change. And I've seen it from all different stripes. People's circumstances, they go up, they go down, and you go with the flow of the economy. And I mean, it's not unusual to have people come in with 6, 7, 8, 10 years worth of tax debt. And that's going back, obviously, a decade or more. And it accumulates and it adds up over time.
Brian, so now the IRS has reviewed the info. How do they determine if someone kind of qualifies for certain collection alternatives? And what are those alternatives?
Well, again, they start with income, and then they start working backwards from there. And they'll say, okay, well, obviously you have certain expenses. Starting with probably your largest, what is your mortgage or your rent? That's usually for most people the largest expense. Do you have a car payment? Do you have auto insurance? Out-of-pocket health care payments every month? Out-of-pocket medical that's not covered by health care? Court-ordered payments, maybe alimony, child support, or some type of court judgment on a debt. All those things are things that the IRS will look at. And when I say accept, it's within reason. And about that, what I mean is this. The IRS has certain what they call national standards that are fixed to a particular county and household size. And so people will come in, they'll say, well, yeah, I've got a mortgage payment. And how much is it? And they'll say, $6,800 a month. That's a real nice house. I'm sure it is. But the IRS isn't going to say, oh, that's $6,800 a month that we're going to just leave alone so you can make your mortgage payment. The IRS standard might come in for housing at maybe, say, just as a rounded number, $3,000. And the person says, well, how's that going to work? I mean, my mortgage payment is more than twice of that. Well, the IRS isn't going to tell you you have to sell your house. But what they might say is that difference between what we consider an allowable standard and what you have, we want that money. And people say, well, that's going to be a problem because if I give that to the IRS, then I'm going to default on my mortgage and then they're going to foreclose and I'll get evicted. And I'll say, yeah. And then the IRS says, that's fine. Bring that eviction, that foreclosure judgment against you and we'll look at that. So we don't let things get to that point. I've not ever had that happen. But that's just a far extreme. And then other things, people say, what other expenses do you have? And really one of the key areas, because a lot of our clients are definitely high earners, they will have a nice lifestyle and maybe they're paying for something that the IRS doesn't consider an allowable or necessary expense. And oftentimes it's something maybe for their kids, like horseback riding lessons for their 10-year-old daughter or private hockey lessons for their 12-year-old son. I mean, those are all great things, and everybody wants to give to their kids, but those are the kinds of things the IRS looks at and says, listen, we're not going to consider that outside the scope of what we can collect. We want to collect that money. And so again, you run into some tough situations where, you really have to kind of work through some things, but that's where the heavy lifting comes in.
Brian, from your experience doing this, where have you seen people make mistakes? Like, where are they running into difficulty when they try to handle some of this stuff across the various stages of where it's at? They try to do it on their own. What mistakes have you seen them make?
Well, they disclose a whole lot of information that the IRS otherwise wouldn't be asking for. It really isn't necessary to establish an installment agreement, or in many cases, even a non-collectible status. Um, so they give away a lot of information that maybe isn't necessary, but oftentimes too, they'll come into it and they'll say, what is your, the biggest thing we see consistently is how much do you spend on food and household products, including shampoo and toothpaste and that. And people will put down, oh gosh, food and so forth. They'll put down whatever. I've seen everything from $1,000 to $8,000 and so forth. And again, the IRS has certain standards, but they'll just oftentimes overstate their expenses. And it's not that they're trying to pull a fast one. It's just, I mean, how many people save their grocery store receipts for the last 3 months? I don't know anybody. And yet these standards by the IRS, I believe forever, and especially these last few years, they're way, way low. Okay. I don't know necessarily how often they adjust them. They make announcements about it, but these standards they're pretty unrealistic. So that's where we have to get a little more creative and really kind of work that case through with our client, with the IRS, to put something in place that's going to be acceptable to the IRS, but at the same time reasonable and livable for our clients.
Well, Brian, as we wrap on this episode, so somebody's listening to this right now. They've been asked by the IRS to provide financial disclosure statements. Like, what would you want them to understand about the role you will play in guiding the communication and reviewing all the info before it's submitted?
Well, and this is also true for the 433B, the business financial statement, because oftentimes people come in and they're good on their personal taxes, but the business has fallen behind. So what I'm about ready to say will apply to the business as well. It's just really, we work through them to find out the accurate number for income, because oftentimes people look at their business income, again, if they own a business or self-employed, and they'll state that as their income. And this is what I make. And I'll say, no, wait a minute, that's not what you make. That's what you bring in. What you make or your net income is less than that. And you can't just look at a prior year tax return. I mean, if somebody in September, October, November is saying, well, I'm going to look at last year's tax return, you're 6, 8, 9 months old. We want to see what's going on currently. And that's what the IRS wants to see. People will say, gosh, 3 years ago, I was making $800,000 a year. And I don't give a damn what you're making 3 years ago, brother. I mean, maybe 3 months ago, maybe 4, 5, 6 months ago. But let's look at where you are now, not what you used to do. Oftentimes, too, people say, I had a good year, but next year's not going to be as good. And I said, why do you say that? And they go, I don't know. I said, well, we can't project negative any more than they can project positive. So let's size up where you are currently. And that's really the biggest role we play, because we can't change the numbers. The numbers are the numbers, what people bring us. It's how you present the information. You want it to be accurate, and you want to do it in the way that's best for our clients.
Yep. It's great advice as always. Brian, thanks for the time and the insights. Appreciate it.
Okay, thank you, Mike.
And thank you to everyone out there for listening to this installment of the IRS Debt and Audit Podcast. If you want to learn more, you want to connect with Brian and his team over at Tampa Tax Relief, do me a favor right now. Visit tampataxrelief.com to connect with Brian and the team. And one more favor, as always, please do us a favor. Hit like, hit subscribe, leave a review, comment, share it with someone who needs to hear it. I'm Mike Leon. We'll see everybody next time.
Thanks for watching. Be sure to hit that like and subscribe button and leave us a review in the comments.